Nifty was suggesting. Mid-cap index moves in step with the frontliners. The advanced decline ratio is positive. So it's a positive start, not a runaway rally. The resistance level we're watching is about 25,650. And if you pull up the heat map, I think once again we will find the IT stocks right on top. The top 4 gainers appear to be IT names. So the Nifty IT index was higher yesterday by 1.5%, and there seems to be some follow-through buying. The buy seems to be more on the positive side. On the way down, outside of IT, Eternal is the stock in the Nifty which has seen the most battering in this month, down 8-9%. And even today, it's the top Nifty loser now.
Well, that's right, Rima. I think, the NVIDIA CEO on software saying that the market's got it wrong. Nobody's going to service better than service now. I think, those comments actually are being latched on to as well. So IT index has seen another 1.5% gain after yesterday's percent rally. Remember, yesterday around these levels is when we saw some kind of resistance and some profit taking. Closer around the 31,000 odd mark. Let's see if today we can build on from there. Stocks in focus, home first because of the large trade. Stock is down close to around 5.5%. D-Development, a stock that's been running big time. That's come in for some cooling off today. So, that's a stock in focus. Volumes are quite large. Manappuram Finance actually started off well in the red, and that's pulled back from the lows. So a bit of a fight back is what we're seeing on that particular name. Talking about stocks that are moving on decent volumes. J&K Bank is another name that's actually moving with decent volumes, and that's up and about in today's trading session. Sanofi Consumer, stocks up 7.5%. Good move is what we're seeing out there. Tejas Networks, they're getting more business. Finally, actually, one would say, that stock, after coming off close to around a third from its peak, it's up close to around 7%. KSB as well reacting positively to its numbers, up 6.5%. And Lur Travenues Tech finally seeing some kind of relief. The stock is up close to around 5%. Week to date, it's still down close to 7%, even after the 6% pullback. But net, it's a positive start to trade. 50 runs on the Nifty. Nifty is doing quite well. Nifty Bank 120 points. But the one that's leading today is the tech index. A relief rally, can it build on?
A relief rally, can it build on? There's a question. We'll be watching out for, whether there is any sort of, large trade that takes place in Eternal or not today, largely because of the kind of volume action that it is seeing. It opened sharply in the red and now has recovered a fair bit from the lows. In fact, it's now spiking at the high point of trade for Eternal so far. It's a recovery of nearly 3% from the lows. So that's one of the stocks. Maruti is the other one which is picking pace. SBI Card from the broader markets is slightly lower. Patanjali is the other one, which was one of the picks that our tech guests did give. And then we are seeing some traction, further sell-off on Home First Finance post the last trade as well, which extends its cuts to about 6% right now. And SpiceJet, after a big gash yesterday, seems to be picking pace once again right now. At a lower price, at 15 rupees, it's up around 7% pop. That is what we're seeing on SpiceJet. Bandhan Bank is the other one which is doing well. And this morning we have IEX as well, which is higher by about 2%. All in all, a decent start for the market, even for the broader markets, where the mid-cap index at a level is up 0.4%. Number of stocks which are advancing, far outnumbering the stocks which are declining at around 1,600 is to 762 on the Bombay Stock Exchange. On the Nifty, in fact on the NSE, the number of stocks which are declining are sub 600. Perfect time to welcome our market master of the day, Karthik Kumar, who's the fund manager at Axis Mutual Fund, joins in. Karthik, the big question is on IT. What have you made of the kind of decline that has been seen, the news flow, the conversations around it, the likely impact, and how much of that is in the price? And is there something that looks, worth at least following at current levels rather than a buy or a sell action?
Thanks for having me. Firstly, with regards to IT, we continue to be underweight as it stands, as we stand right now. While there is terminal valuations and so on and so forth, but even if you look at it in the near term, the growth prospects over this year or the next couple of financial years look quite mediocre, and there are other opportunities there within the markets that one can take advantage of. So, given that context, we still remain underweight. Yes, valuations have gotten better. One of the positive outcomes of painful underperformance over the last few weeks. But I think we need near-term triggers for the stock, for the sector to kind of go up. In the near term, I believe the stock underperformance, we would not see a continuation of stock underperformance. But for the sector to recover, I think we need near-term triggers.
All right, we do need near-term triggers. Just as we were speaking about Eternal, the large trade has actually taken place. Nearly 10 crore shares of 1% equity has changed hands via a block deal. We'll get participants of that later in the day. But, the stock has seen a recovery. So maybe up until now, the pressure was largely on account of the supply that was expected on that block trail. And the stock has from there recovered about 2.5–3% at the higher point of today's trading session so far. Karthik, on a lot of these platform companies, you think that there could be an impact because of artificial intelligence and some of the tools that these guys are coming out with, that there could be some of these companies where a lot of their moats get compromised, and as a result of which there is not enough business case for them?
I think I would think that's an extreme interpretation of it. Surely we need to evaluate what is the impact of AI on these things, and what is the extent and what is the timeline that it could impact it in. So I think these are moving targets, and these have to be evaluated on an ongoing basis. But as it stands today, I think while we need to be aware about it and vigilant about it, but I don't think we need to go to that extreme conclusion with regards to platform companies.
Karthik, hi, morning. You want to first quickly tell us your view on the Indian markets as we begin 2026? 2 months done already, but we've gone through the earnings, we've gone through the budget. What lies ahead for the Indian markets? Because the performance has been so sluggish, and there is one view that what next, right? Many of the RBI actions are done, the GST rationalization is done. Earnings growth expected, but it seems to be priced in because we've been talking about an improvement, and Q3 showed green shoots that maybe it's on track, that a mid-teens kind of or 15–16% kind of earnings growth will happen. And generally markets price it in as soon as there is a whiff of it. So what will get us out of this funk?
Firstly, the sluggish start to the year is in line with our historical pattern, because typically Jan and Feb have been the weakest months for our markets. If you look back historically over the last 25 years, Jan and Feb have been the weakest months for our markets. So that is in line with historical trends. The good thing about the last 2 months is while we started out with FIs aggressively kind of taking money from the markets, that pace has gone down substantially. In fact, it has turned on the margins post the 2 FTA deals. So that's something positive. The other positive side effect is of the underperformance that we've seen to painful underperformance that we've seen to emerging markets is that the valuations have gotten better. So now essentially the focus then shifts to, in my view, earnings, the earnings growth over the next few quarters, and the visibility and clarity of earnings. I think that is what will dictate how our markets kind of move on from here. From a style perspective, what we saw in January was there was a momentum unwind in US that kind of spread to Asia and India as well, where momentum underperformed. And quality and growth also kind of underperformed over the last couple of months, leaving value as the standout outperformer, as we can see from the outperformance of PSU companies across sectors. So value has done quite well. But given the importance of earnings, I believe going forward, it will be a more GARP-like approach that could do much better, where growth becomes paramount. And in that context, I think it's a much more distributed approach that will work rather than concentrated approaches like value or so on and so forth. So that is where I think the market is more likely to head towards.
All right. Hi, Karthik. Good to see you, Ben. A couple of fancied sectors which have corrected big time are railways and defense. We heard what the finance minister had to say in the recently concluded budget. And most of the spends were pretty much in line with what the street was working with. Now, these stocks have come off a goodish deal. What's your view on these names? Have they come to that region where you want to get into them, defense as well as railways? They had a big run, then they cooled off, big time. So are they looking relatively more attractive?
I would say defense, some selective names on the defense side look attractive. Okay. From a purely quantitative framework perspective, railway names still don't show up. But from a defense standpoint, I think there are a few names that begin to look attractive at these levels.
Can you tell us which ones with the disclosure? How do we identify the ones which look good? Is it valuations being less than long-term averages? What is it?
I think it's both combination of valuation being lesser than recent measures, and also growth certainty in terms of growth certainty over FY 27-28. Both those things kind of tilt the case in their favor given the correction, and that is at a specific stock level, stock on a stock level basis within that sector. Yes.
This auto, it's been yesterday the Vahan data came out, the retail sales, and across the board, it looks like it's going to be a 20% kind of growth in the month of February, which means this is the third consecutive month post the GST rationalization that demand is held up strong. What are your channel checks suggesting in terms of auto demand till the end of the year? And can there be a case of EPS upgrades for stocks?
So we continue to remain bullish on autos, and in fact, autos across the space, both two-wheelers and four-wheelers. Completely agree with you that the data has been quite supportive, and we see the data to be continue to be supportive for at least the next couple of quarters, and then we'll have to kind of wait and watch and see basically how it evolves. But I think the near-term data, both on the retail side, manufacturer side, both seem quite positive, and so we'll watch it through the year. But I think the next couple of quarters look supportive for that space.
Were there any investment decisions that you were holding out ahead of the uncertainty on the US-India trade deal, and now that there is some clarity, notwithstanding the sort of daily headline exchange that takes place, but you know that it's not 50% now, it's either 18%, 15%, or at best 10%. What do you make of some of the chemical names which had been underperforming because of this uncertainty, some of the textile names? Are there opportunities there, and maybe some auto ancillaries as well?
So I kind of look at quantitative strategies, and from a quantitative strategies, what matters is data certainty, whether you look at it from a forward-looking basis or a historic basis. So so that uncertainty with regards to tariffs and policies and the FTA meant that I didn't have much exposure to some of the sectors that you've mentioned, and that still continues to be the space. That still continues to be the case. Sorry. So I'll continue to monitor the data in terms of how they evolve and how they kind of feed into the larger process, and then take a decision when things improve materially. But as it stands right now, we still continue to, at least on the purely from a quantitative framework perspective, we still continue to remain a bit light on the sectors that you mentioned.
All right, Karthik, we talk a lot about equities, but the asset class that's really made big money has been gold. Even those on a global framework, even those dips that you're seeing actually are getting bought into. And gold, after correcting, I think it pulled back close to 10-15%, and it's back closer to the peak. What's your view on gold? And, as a percentage of your portfolio, do you think it requires a higher allocation? And if yes, what will it replace? The safer bonds, or, will it replace the equity?
So, I think gold has a longer-term structural story in terms of dollar weakening and looking for alternate and global central banks across looking for options aside from that. So there is a longer-term story which I think is driving that. So, and we also believe that investors should have allocation to gold and silver, so still continue to stand by that. We remain constructive on both those asset classes going forward. With regards to what should be the allocation, that is on that I think is more on a case-to-case basis. But I think there are no two thoughts about it. One should have allocation, and whether you have it through multi-asset funds or whether somebody does it proactively at a portfolio level, I think that is a decision on a client-by-client basis.
Right. So when you said that you look at quantitative data and quantitative strategies, fair to assume that you look at it on the short side as well, or is it just a long only?
So it's mostly on the long only. All these are mutual fund strategies, so we are looking at long only strategies as it stands right now.
Is there anything that has swum into your ken very recently because of the movements that we've seen already, and that's looking a lot more attractive?
We continue to remain bullish on power T&D names, autos, financials. pretty much broad array of financials. Those are large overweights, and the underweights remain staples, IT, utility names, and some of the commodity stocks in the commodity space. Those remain the underweights.
Okay, thank you very much, Karthik, for joining in. That's the view coming in from Axis Mutual Fund. They've got a bit of a domestic bias over export-oriented stocks like IT, and IT is still underweight even after the correction. Though today IT is doing well, even mid-cap IT, so it's a broad-based recovery. Birla Soft 2.5, eClerx 2, Hexaware 1.5, Persistent 1.3, Oracle Finance 1, Tata Elxsi is up 1. The Nifty IT index also is up close to about 0.8%, but still this month it's down close to about 19%. So the gashes are deep, but for the last 2 days it's attempted a bit of a recovery. Shriram Finance is now your top Nifty gainer. You've got life insurance companies in the fray on the way up, SBI Life, HDFC Life. Eicher Motors is up 0.8%. At a broader level, we should pull up the Nifty Metal Index, and the other one is the Auto Index. These were the two pillars of the market outperformance yesterday. The Nifty Metal Index is flat, so no follow-on rally there, but it's had 2 good days on the trot, and autos too, not doing too much.
All right, well, let's get to our next management. Mr. Rajiv Mantri, the Chief Financial Officer at Bandhan Bank, joins us on the show right now. Hi, Rajiv. Good to see you in. And I'll tell you what, in this year itself, the stock price is telling you that the street believes maybe the best is yet to come and maybe the worst is behind. At least just going by the stock price. If you could argue in the last few years, well, it's still a far cry away from those levels that we saw. That said, we want to understand a couple of aspects. So let me just state out a few points that we're looking at. Progress on the NIMS expansion. Is there a recovery underway in the MFI segment? And the path towards a sustainable ROA of around 1%. Well, Rajiv, let's start off with point number 2 then. Let's talk about, the MFI book. I think that's a third of your total book right now. And the feedback you're getting is things are actually improving on ground. So could you tell us, what are you observing? And also, you've been talking about increasing your secured book. As a percentage of the mix, what is the proportion you'll want in to come from the secured book? Please go ahead.
So good morning to you and good morning to all the viewers. I think definitely we are seeing a recovery coming through in the microfinance segment. The cycle has been fairly long, lasting almost about a year, last 1 year. And the main reason for this cycle turning adverse was because of the whole over-leveraging situation that happened in the market. But what we had sort of guided the market beginning of this financial year was that we will see sequential improvement in the portfolio quality. And then by Q3, we should expect a more profound recovery to come through. And that's exactly what we have seen. The slippages that we actually saw for the bank between Q2 and Q3 improved by almost 280 crores, of which the microfinance improvement was around 200 crores. So I think that is something which gives us confidence in terms of how the portfolio quality improvements are happening. What we also see is when we look at the forward flow rates, from the various DPD buckets, towards the NP as well. We are definitely seeing improvement on that front as well, right? So just to give you some stats, the sort of forward flow in terms of the collection efficiency, which is X buckets, which was almost about 99.5% in Q3. In the latest sort of quarter, early trend suggests it's gone up by almost 20 basis points to 99.7. And I think that is giving a good confidence in terms of how the improvement is happening.
Okay.
We do expect this to continue in terms of an improvement on the portfolio quality, albeit on a gradual basis over the next few quarters as well.
Got it.
And
what about
I think the second aspect on microfinance is really about the growth. I mean, as you know, because the industry was going through a cycle, we clearly saw that the overall industry actually has shrunk by close to about 16% in terms of the advances. Within that context, so this is from December 24 to December 25. And within that context, from a Bandhan Bank standpoint, we saw actually our book degrow by roughly around 10.9 or 11%. We also did a significant ARC sale in the quarter of December, which was around 3,200 crores of NPA, of which about 2,800 crores was relating to the microfinance portfolio, which we call as the Emerging Entrepreneur Business or EEB. And if we normalize for that, we actually saw that the degrowth year on year was only about 5.9% or around 6%.
Okay.
In fact, sequentially, if we normalize for the ARC sale, we saw a growth of about 1,100 crores.
Right.
So this is also giving a confidence that we are seeing disbursements go up. We are continuing to hold our guardrails that we had implemented, be it the 3 loan criterion, be it the cooling period concept, or various other guardrails that we had put in place.
Rajiv, sorry to come in. So we get the point. MFI is on the mend and things are looking up on that portfolio. The secured book, that as well has moved up on a very small base as a percentage of your book. How much can it occupy? Very quickly.
Yeah, so I think secured book, the momentum is on. We had seen about a 27% growth on a year-on-year basis. So that is being driven by housing portfolio, retail assets, which is the secured retail assets, as well as the wholesale banking portfolio. So I think the growth in that has been quite encouraging, about 27% growth there. We had, as part of our strategy, set up that by FY27 end, we will increase our secured mix to about 58%. We started our journey at about 42% in March 24. Very happy to say that we have already reached about 57% by the end of December 25. So we're running a little advance on that. Of course, we will continue to pivot towards a higher secured share. But the pace of change of secured mix now can be a little less steeper as what we've seen in the past.
So when we speak about the secured book increasing, etc., there are multiple impacts of that as well. On the one, yields go lower. That could have a problem on the NIMs. NIMs may compress, but at the same time, your credit cost reduces, and you have set out targets for all of them as well. For credit cost, for one, it's 1.6 to 1.7% by the end of FY27. Which implies a near 40 basis points reduction every quarter. Are you on track for that? That's point number one. Secondly, a comment on your NIMs and yields as secured book increases. And as a result of all of this, your ROA target of 1%, what are the drivers for that?
Yeah, sure. So I think if you look at the credit cost, a year ago, we were almost about 4.1%. We had steadily reduced that, I think, by the Q3 of this year. We brought it down to about 3.3%. So the trajectory of improvement in the credit cost is very much on. Here on, we expect the credit cost to sequentially continue to improve. And yes, the guidance that we had given is by the exit of FY27, we expect that to reach around 1.6 to 1.7%. I think the broad logic of that is a third of the book, which should be in EV or microfinance, at about 3% credit cost, sort of steady state credit cost of 3%. And the 2/3 of the book, which is largely secured, should be around 1%. So with a weighted average of about 1.6 to 1.7%. So that's the aim, and we are clearly steadily making progress in that regard. On the net interest margins, I think we had said that Q2 is what we believe would have been the bottom, and we got severely impacted by the repo rate reduction, which we could not transmit to the depositors. We could only transmit to the savings account holders, but not to term deposit holders, as our deposits are locked in for a longer period of maturity. However, we had seen an improvement in Q3. The NIMs went up from 5.8% in Q2 to 5.9% in Q3. And we are confident over these 3 quarters, which is Q4, Q1 and Q2, about a 30 to 40 basis points improvement in the NIMs is what we can expect. This is largely driven by the repricing of the term deposits that come in for maturities in these 3 quarters. And we had seen that the rates have really come off compared to the last year, where we stand right now. So we are fairly confident towards that. Your last question on the return on assets, we definitely have, seen a sequential improvement. Of course, Q2 was a low quarter for us, which was around 0.2%. It went up to 0.4% in this quarter. Our guidance is by the exit of FY27, we are aiming to reach around 1.6 to 1.7%. Give or take 10 basis points. The reason for that and the way in which we'll be able to achieve it is we expect the NIM trajectory to improve further. Apart from that, there is a lot of effort that the bank is putting in place in terms of driving the other income growth. We already have seen a good momentum in our third-party product sales. As the microfinance disbursements improve, we should be able to see an improvement coming through. Sorry, just give me a second. We should be able to see an improvement in the disbursement-linked processing fees. And also, we are looking at introducing newer capabilities in our wholesale banking portfolio, which is around FX, trade, as well as transaction banking, which should be able to generate some new lines of revenue.
Just to confirm that number, you said ROA will be 1.6 to 1.7% by exit FY27. That's correct, right?
Right. So I think for the full
That's
year,
from
it may be
0.4%
lower.
right now.
For the full year, it may be lower because we're starting from a lower trajectory of 0.4% now to reach to that level. But yeah, that's our aim to reach by the end of FY27.
Okay, just one word answer because we're out of time. Rajiv, so FY26 loan growth, 11 to 12% is what you told us last time. That holds. And how much can you scale FY27 loan growth to?
So I think the overall loan growth CAGR that we have been looking at for the next 2 to 3 years was around 15 to 17%. We are still aiming for that. The breakup of that is really the secured book to grow faster, around 20% plus, and the unsecured, which is largely the microfinance, to grow between a 5 to 10% positive territory. The challenge we've seen is around micro because the last 1 year the book has degrown as opposed to increase. What we are working towards is from a negative 10% on the microfinance year-on-year growth rate right now to take to a positive 5 to 10% growth. On the secured book growth, I think we are fairly confident and the momentum is pretty much on. So that's what we're aiming at, around a 15 to 17% CAGR over the next 2 to 3 years. And we hope to try and meet that by the end of FY27 as well.
Rajiv, very quickly, you believe the worst is behind for the bank? In the past, we have seen ROAs even in excess of 3%. I recall, I think that period between, 2017 to 2020, maybe a timeline will be a little off, but I recall there were very, very great days out there. So shareholders will be wanting to know, do you believe the best is ahead and the worst is behind? Would that be fair?
Absolutely. I think I would be confident to say that because what we're trying to do is a structural change in the bank towards a balance sheet which is more resilient. And what we're trying to do is improve the secured mix, which provides more consistent set of returns. At the same time, we want to retain our leadership position in the microfinance segment, which allows us to be able to provide a little higher returns on the assets. So I think it's a more stable balance sheet, more consistent set of returns that we're trying to work towards.
So is a fundraise on the cards?
Well, at the moment, our capital ratios are fairly comfortable. We have 17% tier 1 and 17.8% overall CRAR. It allows us to be able to grow at least for the next 1 to 2 years, given the advanced growth that I just mentioned, and given it's still pivoted towards a higher secure mix.
But is there a fundraise on the cards? Have investors reached out to you? Since things are on the mend, ROA is looking up, credit costs coming down, growth coming back as well, and the worst in terms of the MFI sector behind.
Yeah, so I think we have been discussing with the investors. We've been doing the outreach. We've been attending some conferences as well. And we've been explaining, I think, the similar points as I just mentioned earlier to the various investors as well.
All of last year, a lot of the foreign institutions were looking to buy Indian banks, Indian NBFCs, etc. Have you had any conversations around that as well with any sort of global bank, global investors on a strategic basis rather than just financial?
No such conversation at the moment. We have really a good support coming from all of our investors. We have 40% stake held by the promoter, which is our Bandhan Financial Holdings company. So at this stage, there is no such conversation that's happening.
Thank you, Ramesh, for joining in. Always a pleasure chatting with you. And thank you for this candid chat. We will slip into a break. On the other side, Barclays Private Bank's Julian Lafarge joins in to talk about markets and more. Stay tuned for that conversation.
Welcome back. The market's holding up well. Infosys has moved to the high point of trade. Alongside that, we do have some traction coming in on names like IndusInd Bank, etc. as well. The Nifty closing in on that 2550 mark. The broader markets have one shade better, 0.2% in terms of gains for the mid-cap index. Nearly 2,000 stocks which are in the green right now. But conversations around AI continue as investors on Wall Street and around the world assess the AI disruption and its impact. NVIDIA CEO Jensen Huang did say that markets have miscalculated the AI threat to software companies. In fact, in an interview to CNBC, hours after the chip behemoth issued an upbeat sales forecast on strong AI demand, he spoke about this. And let's actually hear that out, and thereafter we'll continue this discussion in our studio.
I think the market's got it wrong. I think it's very likely that these companies that we're talking about are going to introduce agents that run on their platforms. You know, these agents, of course, they have to be experts in what they do, and nobody's going to understand customer service better than ServiceNow, and they're going to come up with agents that are really fine-tuned and optimized for the type of work that uses the tools that they have. In the end, also, we need the tools to finish their work and put the information back in a way that we can understand, and that we call them system of records. And so each one of these tools have their own system of records. Those system of records exist because we put them there and we use it so that we understand the information that's finally complete. And so those system of records will still be ground truth, and they'll continue to be ground truth. And now the agents will, help. They will use it, and they will populate the system of records. They will use the tools that are available on these platforms.
Markets got it all wrong about the role that software companies will have to play in this agentic AI world. Previously, he had said it's illogical to expect that they would be replaced. But we've got someone, an expert joining in the studio who can talk about the AI euphoria, now the moderation that we're seeing, where markets are headed, global emerging markets. Julien Lafargue, Chief Market Strategist, Barclays Private Bank, joining in. Julien, thank you very much for joining in. I was just reading a recent report of yours, 2026, The Interpretation Game. Interesting title. Can you take us through the broad thesis?
Sure. Well, I guess the broad thesis is that in 2026, investor will have to look at every single data point, trying to interpret one thing and one thing only, really. Are we seeing productivity gain related to AI? Because if you think about it, those productivity gain underpin everything. They underpin the AI trade. If there is no productivity gain, there is no demand for NVIDIA chips, and there is no demand for AI. And it's also very important when it comes to another issue that we haven't discussed in a long time, it feels, but sovereign debt. Because the only way to get out of this debt spiral around sovereign debt is really through productivity gains, through higher growth. That's how we're going to reduce the debt burden. So for us, the only thing that matters in 2026 is productivity gain. The problem is you cannot observe productivity, so you have to interpret each data point with this lens of are we seeing productivity gains or not.
So what are those data points that you would be looking at to absorb productivity gains? Because like you said, it's not visible. No one comes up at the end of the month with a report that, okay, this was the productivity gain.
No, exactly. I mean, you do get some productivity figure when you get US GDP numbers, but that comes with a lag and on a quarterly basis. So I think it's going to be signals like we see in the earnings report, company finally talking about actual productivity gain. Now, I'm sure you interview a lot of CEOs and CFOs, and all they say is, yeah, we're seeing the potential gains that AI can bring. Nobody has really been able to quantify that. Exactly. And so we hope to see in 2026, probably Q2, Q3, some CEOs, some CFO coming with tangible numbers, like these are the productivity gains that we've been able to achieve. So that I think is the key data to focus on.
Hi, Julien, good to see you in. Do you think that these productivity gains in turn will impact economies, impact consumption, discretionary spends as well? Where are you on that argument?
Well, so I think that you hear a lot of people saying, oh, look, since ChatGPT came out, if you look at US productivity, it's gone up a lot. But we would challenge that view, because what you're seeing is just productivity gains that are similar to any productivity gains we've seen post any recession in the US. What happens when you have a recession, in this case the pandemic, you have a reallocation of labor. So people change job, they become entrepreneurs or whatever, and that leads to an increase in productivity gain. So we think we haven't seen any real productivity gain linked to AI just yet. We think is going to come through. Hopefully this year. I mean, it has to come out this year, otherwise we're going to be maybe in trouble.
So otherwise that trade will unravel. But be that as it may, you have the outside-in perspective to markets like India as well. What are your thoughts on that? Because barring February, for the last 6 or 7 months prior to that, we've constantly seen money going out of India.
Yeah.
What's causing that?
Well, I think India had been a very popular trade among international investors for a long period of time. Most recently, I think India is less in focus. I don't think people are necessarily worried about India. I think it's just that they feel that there are better opportunities elsewhere when allocating global capital. Because there are a couple of things that are lacking in India when you look at the stock market. One is, of course, the AI exposure. And second, it's sad to say, I'm sure, and I'm really happy to be here in India today, I'm sure it's not the case anymore, but a lot of people still see India as this software-led type of economy, service-led type of economy, which could be challenged, in fact, by AI. So I don't think people are necessarily worried about that too much, but I think they look at China, they look at Japan, and those are, at the moment, more exciting stories for global asset allocators.
Julian, you're advising the richest people in the world, and they want to get richer, right? What's the advice that you're giving for 2026, top down, globally, like all asset classes included?
Well,
where can maximum money be made this year?
Well, I think the key this year, that's going to sound a bit boring, but it's really about diversification. Because, I don't think anyone has been able to capture the change and the shift in narrative we've seen just since the beginning of the year. We're 2 months in and we've seen everything happen already. So you really need to be diversified. And what you need to be is also to be focused on, I think the diversification should also be geographical, right? It's not just about one sector versus the other. I think a lot of people have been overexposed to the US market, and that was the right call for many years. We think this is changing. You want to have exposure to other regions, in particular emerging markets.
Okay, all right.
Do you want to break up? Sorry, just one follow-up. Do you want to break up how you will diversify $100?
So, well, look, for us, equities remain the engine of growth. So if your goal is to become richer, you definitely want to have exposure to equities. There's no fixed income that's going to allow you to do that. We also see some benefit in being exposed to more alternative strategies, I would say. Strategies that are not necessarily betting on the market going up or down, but are playing the dispersion. Because if there is one thing that we observe this year is very elevated level of dispersion among sectors, among stocks. So we would focus on that.
You just said $100 for a person who...
That's why I didn't answer the question, because $100 is not enough.
To be very honest, she'll come to you with $1 billion shortly. But Nigel, go ahead.
Yeah, all right. No, I just wanted to understand, with regard to the US markets, the point that you made, that mother market has done very, very well. That's good actually for global equities. Yes, the Indian markets have underperformed. But do you think the US markets are getting to a stage where it's, could go through a phase of consolidation after the recent run? That's point number one. And point number two, I wanted to understand with regard to Trump's tariffs. Peak Trump seen or peak Trump to be witnessed?
Okay, so on the US side, I would say, I think consolidation is the right term, more so than, a significant pullback or anything like that. I think you still want to have exposure to the US. That's still the main economy. That's still the main market. So, but yeah, people are going to be looking at other regions, and I think that's going to weigh on the momentum in the US. When it comes to tariff, look, I think the peak was reached on Liberation Day. And since then, it's been just a walking back of a lot of the announcements that were made that day. And I think this is going to continue going into the midterm election. So, for example, we had this announcement that it would be 10% across the board tariff. The next day was 15, but in the reality, so far, it's only been 10, and the 15 is not sure. So I think this is the direction of travel.
And just to finish the point with regard to the US, how many Fed rate cuts to be this year? We're going to have a change at the helm. Some thought it's going to be 3 or 2 or 3, and then some are saying that we may not get any. Which camp are you in? Well,
we're probably in more of the 2 camp, but the reality is, is it 2 or 3? I don't think it matters for a lot of people, to be totally transparent. I think what matters is that interest rates are coming down, and I think investors need to think about that in their allocation in particular.
I just sort of ask you that because from an India market perspective, the dollar index is important since the emerging markets track that very, very closely. But it's good to have you in the studio. Thanks a lot for coming down, and we look forward to more such visits. And Rima's keeping the 100 billion ready.
Billion ready, at least for now. But, for those who are not having billions, what about gold? I mean, is there a view that you have there?
Yeah, so for us, look, it's a key part of any well-diversified portfolio. I think you don't want to own gold for speculative reason. You want to own gold because it plays a key role in portfolio, that until very recently, bonds, in particular treasuries, haven't been able to play. So for us, is this anchor in portfolios. We continue to have some exposure. We reduced a bit the exposure when we felt that things were getting a bit too hot. But we maintain a decent amount of gold in our portfolio.
So very rich also get fairly adventurous with crypto. You have a view there?
Yeah, sure. So for us, again, we look at a portfolio. This is a new asset class. Can we use it to make our portfolios more efficient? And the reality is, at this point of time, we cannot. We cannot make it work in a traditional portfolio sense. It doesn't mean you cannot have access to it and you shouldn't have access to it. But when we design portfolio, it doesn't fit there because volatility is too high, because the correlation is unclear. Sometimes it's correlated with the NASDAQ, sometimes it's not. So for us, is more something that we would do on the side rather than a part of a core portfolio.
Julian, always a pleasure. Thank you very much for joining in. Hope you enjoy your India visit and make a trip once again back home. So in India and tech stocks, interpretation game is all about interpreting whether AI is going to help software companies or it's going to hurt. And that's been the raging debate when it comes to India for the last so many weeks and months now. So this gives us the perfect segue to invite Ramesh Lakshminarayan, Group Head IT Chief Information Officer at HDFC Bank. Ramesh, thank you very much for joining in today. I think this is our first conversation, live markets. We have so many of these Indian IT companies, and they've been battered out of shape because of two concerns. One, fears of revenue deflation, and two, perhaps enterprises like you will move to AI agents and therefore reduce the work or the spend of Indian IT companies. Now, you are in an enterprise, you work with Indian IT companies. If you could tell us the extent of deflation that you've seen. So when your contracts come up for renewal, how much are you pricing it down? And is there a thought to reduce the services spend and maybe experiment with these foundation AI models? Oh, I think you're on mute.
Thanks, Rima, for having me here. Can you hear me? Am I audible?
Yeah, we can.
Yeah, no, thanks, Rima, for having me here. First time on this show. Glad to be here. I think it's still very early days, to my mind, in terms of putting the impact together. Look, this space is changing very fast. I think every week we are seeing some announcements. Every day, in fact, there is something new coming up, and enterprises don't necessarily react in that way. So you need to kind of give it a little bit time. We will calibrate. As of now, like I said, we are very focused on what we are building and how we are looking at the entire AI space. And while we're kind of dealing with our partners, we're looking at saying how do we really, navigate to the new age solution. I mean, today, for example, do you really need to build a SaaS application? And if you really don't want to build it, what is the alternative? If agentic AI has to come in there, how can the partners help it? That is the conversation that I'm right now kind of seeing. Early days, I think I don't necessarily see the recalibration happening in a very, very, deflation rather happening in a very big way. I think there will be recalibration to my mind. The models will change very, very fast, and we will see how this goes.
So if you could, quantify that sort of recalibration, because just before we were having this conversation with Julian, who was speaking about the key monitorable here being productivity gains, right? So if you could give us a sense on how this will work for you in terms of either one, reducing response time, increasing service quality, improving as a result of which the sort of revenue or conversion rates, those metrics that you monitor, and on the other part would be reduction of costs. So on both those parameters, have you set yourself any target or have you seen any initial trends and any potential that you can quantify here?
Yeah, I think it's again, like I said, the way to look at it is not look at isolated use cases and say, hey, I will get a certain percentage. The way we have looked at is, can you go back to the foundational processes? See, just overlaying an AI on top of an existing process is not going to make sense. And the reason I'm saying is, take a simple example like acquisition journeys. In the old world, you will have the UIs, the click-throughs, certain number of screens to go through. In the new world, maybe it will just be a AI, a window on top of it. And that doesn't mean the process behind it, kind of changes in the sense that, you will probably have some extraction engine pulling a document. You will have a scoring model that's running in parallel. Now, can that, for example, reduce the first time right? That's one of the big KPIs that we track. In fact, that's one of the initial KPIs that we're trying to move towards, saying when we get something like that, can we get the documentation right for the customer when he comes in? Second, is the turnaround time. I mean, clearly, the number of hops that you go through, especially in some sectors where the acquisition is still not fully digital. I mean, for example, in SME sector, you might.
Oops, we'll try and
multiple kind of iterations before you kind of approve. That is the other part that we are kind of looking at very carefully. Then, of course, we do have, the third part, which you said, our own productivity. I think there we are seeing gains, especially in the back-end coding side. Coding is a capability. See, the way we see this whole landscape play out, you need to look at what capabilities AI will drive. For example, bank has extraction, core extraction as a capability, search as a capability, voice to text, text to speech as a capability, coding for our own development as a capability. So when you're building this foundational layer, can you get your first time right? Can you reduce your turnaround by X? Can you kind of, obviously reduce the cost? The way we are seeing all the three playouts are happening depending on the use case. And one of the principles that we have used here is to build a centralized platform here. Unlike, many of the market movers, we've not gone to a third-party partner. Actually, we built our own platform because our idea is to have a centralized AI platform that's able to enable all these use cases, and thereby the measurement of the KPI or the measurement of the benefits is real and it's on the go actually. So that is the approach we are taking. So it's kind of right now early calibration. We are seeing definitely benefits, especially in turnaround times. I would say that's the first part. And second is definitely reallocation of the resources to the front end in some of the key projects. So these are two areas that we are definitely seeing some benefits.
Okay, hi sir. Good morning. Good to see you. If I take a reference point, global banks like JP Morgan, they spend a large amount of money on tech, on AI, cybersecurity, and other initiatives as well. As a percentage of revenue, it's ballpark around 10%. But as a percentage of expenditure, it'll be closer to around 20%. Would you all look to increase your digital spend?
So I think we are again pretty much on global benchmark standards. It's similar ranges that we spend in if you go and look at it. And see, technology continues to be an area of investment. I mean, those days are gone when technology will be a support function in a bank. In fact, HDFC has a very different thought process in the way that we are pivoted from a partner-driven technology development. While we do work with a lot of partners, but certain areas we have very strategically pivoted to a factory approach, where we are building a lot of our digital products. So we've got factories in Bangalore, 2 factories in Mumbai, 1 in Gurgaon, and then we just opened 3 days back in Guwahati. Why are we doing this? Because just like some of the global banks, if we don't convert ourselves into a technology development first kind of a company, we're not setting ourselves for future. So obviously the spends are going in that region. So the nature of the spends is changing. It's no longer about looking at maintenance BU, while they're very critical, resilience, and all of that area is boxed in, and those costs continue to kind of go at the same level, just to ensure that there are no hiccups. But the spends are moving into areas where you can kind of see the business benefits quite quickly, especially in the area of AI-driven development.
Okay, just one final question. We can keep it short. As the nature of spends is changing, the fear is that it's crowding out the spends that would have otherwise gone to IT services companies and vendors of yours. Now, you yourself have taken so many internal projects. You're doing it yourself. In that sense, what is happening? Is it negative for Indian IT companies?
I think they will have to relook at the model, Reema. I think that's the fundamental take that I have, because just the T&M model or the application development through people, those days are gone actually. So really the value that they bring to the table. So let me give an example. I mean, for example, if somebody comes to AI solution, for example, in detecting a fraud opportunity, I think that is something that we would kind of take a look at it. Hey, tell me how is your fraud model more effective, and is it kind of market benchmark to detect better fraud controls? That would be the conversation, and not saying, oh, I will need this many number of people to do a project or this many resources to a project. So the entire conversation is changing to value adds actually, and not basis resources, and that's going to be a significant shift for the IT services company. And I think they are calibrating as we speak. Some of them will calibrate faster, and those are the ones that probably will come out winners in this race. The way I see this, as they start getting ready for this AI rush.
Thank you, Ramesh, for joining in with your insights. Great conversation. Out of time, need to slip into a break. On the other side, Shilpa Rao to Prabhudas Leeladhar will join in for some technical trades.
Welcome back. Well, the markets are building on to the gains. The Nifty is up close to around 85 points and the breadth of the market pretty good. Good time to get in Shilpa Raut, Senior Analyst Derivative at Prabhudas Lirathar. Hi Shilpa, good to have you on the show. Give us your call on the Nifty. Do you think we are in for a bigger run? We're already 85 points higher, so the fresh trade on the Nifty and a couple of trading calls. Please go ahead.
Good morning, Nigel, and thank you for having me on the show. Talking about Nifty, we have a good support at around 25,450 to 500 band. That is where we are timely again and again testing and seeing some sort of a bounce. So we should go long, and the resistance is placed around 25,700 zone. So we still have a room on the upside to play. And for Bank Nifty, the support comes at around 60,800. So again, you can go long here. It can do 61,700 zones. So definitely still a long view on Nifty and Bank Nifty.
All right. And individual stocks, what are you backing?
I have two buys. The first one would be on BEL, Bharat Electronics. The stock is trading around 442 in futures. It is looking good. It has a support around 435. So one can go long here with a target of 455 to 460 zones. The other one would be from the pharma pack. Cipla is very well placed. Futures trading at around 1369. It has a good support around 1340 and keep targets around 1400 zones from here.
All right, Shilpa. Thanks a lot for stopping by and giving us your views on the index as well as individual stocks. We'll take your leave on that. And in fact, we'll wrap on the equity coverage of Bazaar so far. In fact, on the other side, the special segment, it's the economy. Lata speaks to Kamaksha Trivedi of Goldman Sachs on the rupee and the dollar index as well as rates. Stay tuned for that.
Welcome to It's the Economy. The rupee has stopped its sharp downward journey seen till January end after the US trade deal was struck. However, in February, despite the slowing of foreign portfolio outflows and even some inflows, the currency isn't appreciating much, probably because of fears that software exports may begin to decline. Separately, the DXY, the dollar index, which we watch very closely, after the sharp fall in the first half of last year, 2025, from 107 to 97, has pretty much moved in a narrow band of 96 to 100 for the past, 8 months. And the other big currency we have to watch, the Chinese renminbi, has been appreciating steadily, almost by 1% a month since mid-2025. So where are these currencies headed from here on? And how will Indian yields pan out? Separately, another question. For all these questions, I have with me Kamaksha Trivedi, the head of Global FX, Interest Rates and Emerging Market Strategy at Goldman Sachs. Kamaksha has been good enough to come to the studio. Thank you very much, Kamaksha.
Good morning, Lata. It's a pleasure to be here.
Well, we have a barrage of questions for you. Let me first start with the rupee itself. How worried would you be about this AI headwinds? And, at the moment, the flows are there. We've got 2 billion of FX flows this month net. First time in 11 months that it has been so positive, but no appreciation in the currency.
Yeah, I think I am more concerned about AI, the software sell-offs, and what it means for the equity market. But the honest truth is, Lata, I am much less concerned about it from a rupee standpoint. I think the Indian rupee is, broadly speaking, in a good place. It's underperformed, as you were mentioning, over the past year. It's stabilized a bit now that the big headwind of the external trade deal has gone off. And in fact, India is one of the perhaps unlikely beneficiaries of the IEEPA tariff ruling and the new tariff rates that have come on. Actually, the effective tariff rate on India probably has gone down as a result of that. Now, putting the rupee in broader perspective, I mean, it's modestly undervalued. And I think that that's not a bad place for it to be. I think we have to be careful about seeing the rupee always, versus the dollar, but on a broader trade-weighted basis. You mentioned China, many other currencies. I mean, the Indian rupee came from a relatively overvalued level at the start of last year. It's now modestly undervalued. Indian macro balances are in a good place. So I don't think the rupee is going anywhere fast. I certainly don't expect it to appreciate massively. I think, if anything, the chances are that we will depreciate slowly over the course of the year, but not at the pace that it happened last year.
Oh, yeah. That was a scary one. We were not prepared for 6% at a time when the dollar itself was falling.
That's right.
So, you would discount the BOP outflows. There is a fear that software exports will decline. I mean, I know you're saying that that's not the biggest problem of AI. Yeah. Jobs and other things is what we should worry. But just to round off the rupee argument, software exports decline is not a worry?
Again, I think so far, no. I mean, if anything, software export numbers have actually been quite constructive, even in the last month, right? And I think that one of the interesting things about the AI developments that are taking place is that they're actually having a positive impact on things like earnings, even as perhaps they're having, a less positive impact on things like jobs, for example, right? And so you could still see that, even as perhaps, hiring across a lot of sectors, including in India and other AI-exposed areas, might slow down somewhat, the earnings and revenues and inflows that come on the back of that might still be pretty high. In fact, might be higher because of the productivity gains that some of these technologies provide. So I am, again, less concerned about the BOP overall, what it means for inflows. I think there are more serious challenges, of course, in terms of skills and transitions and labor market issues.
Yeah, actually, it's very dichotomous. At one point, we're seeing resilience and growth, and for the future, we are, staring at fears of joblessness. But yeah, let me stick to the monetary side of things. You have a very interesting report that EM countries, EM economies, have become more resilient to global risk-offs. I mean, you've given a comparison of how we behaved. Yields had to be pushed up during the taper tantrum. They had to be pushed up during the Lehman crisis. But now we are not seeing Reserve Bank set rates because of any global shocks. And you're saying that's a general phenomenon?
I think it's becoming a more general phenomenon. You're absolutely right. And I think it's a huge step forward in the maturity and evolution of emerging market investing. In fact, I think India is a poster child of this, as you mentioned. Like, you don't have to do that kind of pro-cyclical rate hikes in response to global shocks that you may have nothing to do with. And just in order to stabilize your own local asset markets, whether it's the bond markets or the foreign exchange markets, you have to hike rates and damage your domestic economy. Increasingly, what we are seeing is central banks are not facing that trade-off. The terms of that trade-off are improving. And again, India is a good example. Why is this happening? It's happening on the one hand because of better, improved monetary policy frameworks that have been put in place, the inflation targeting frameworks. And those are giving the bond markets, currency markets, much more credibility, much more anchoring around the policy rate, around the inflation target. But equally, the fiscal side of things. And again, here India is a good example. The central government fiscal consolidation path has been actually one of the more impressive ones. They've been very consistent about it. It does not show up in India being the sort of brightest star amongst emerging markets at this juncture, but it does provide a lot of resilience. And that's one of the things that we are seeing.
That's right. I would like, if time permitting, come to how FIs look at Indian bonds as well. I mean, inflows are very good for us at the moment. But what do you make of the bond yields themselves? At the moment, the market was scared by the fiscal borrowing number, but Reserve Bank has been pouring liquidity, or at least kept it very easy. Where do you see Indian yields? Does the 10-year go to 7, 6.8? That was the fear.
No, I'll take the other side of that. I think that, our fair value sort of medium-term target for 10-year bond yields in India is around 6.5%. I think that, you probably trade in a 20, 25 basis point range above that. Right now, we are at the higher end of that range. I think, over time, we should probably moderate lower. I mean, it is true that the Indian curve is steep, but globally curves are quite steep. So again, we have to think about India in the context of that global dynamic where, curves are steep in the US, curves are steep in Japan, curves are steep, across a number of emerging markets as well. And India is not, immune to that broader steepening trend. But if I think sort of medium term, if I think about kind of given the fiscal trajectory of the central government, given where inflation is and, how moderate it's been, given where I think rates are, I think 6.5% is a reasonable anchor point for yields.
You may be finding people coming towards your... at the moment, you are an unusual view, but people will migrate because the new CPI series is indicating that actually our inflation may not touch even 4%, maybe 3.8 this year. That is FY27. But let me just zoom out. Since you look at, so many countries, there is a Goldilocks playing out everywhere. I mean, in India, we are surprised that growth is really good and inflation has been benign. Likewise, in the US, all the numbers are looking excellent and inflation is like, okay, 2.4, it's not really kicking up. First of all, what's accounting for this? And will something give, or can this continue?
I think one of the very interesting things right now is, as you mentioned, I think the macro environment feels pretty Goldilocksy. The market environment less so. And I think that that's an important, difference to bear in mind, that I think that the market cycle is later than the macro cycle. So we're pretty confident on the macro side. We think growth is going to be good. We think inflation will decline. In fact, I think this is the year where most developed and emerging markets are going to put that post-pandemic surge in inflation behind them. So the growth and inflation mix does look very good, does look very Goldilocksy. But markets are richer, valuations have gone further, credit spreads are very tight, and I think you are going to see a lot more market volatility, a lot more churn underneath the index level, some widening in credit spreads as well, alongside this benign macro. So I think we have to be careful not to conflate the two. I think the macro will be good, it'll provide a floor to markets, but I do think markets are going to feel choppier, they're going to feel a lot more uncomfortable than last year.
Probably they're overreading the future as well, aside from being already richly valued. A point taken, 96 to 100, 101 for the past 8 months. How does it give and in which direction?
We think the dollar is weakening further. I think it's still an overvalued asset on our metrics, between 10 and 15% overvalued still. And what that overvaluation reflected over many years was a kind of exceptional macro and market performance of the US relative to other equity markets globally, relative to other economies globally. We are expecting to see a much more balanced performance. You already saw that in 2025. We think we are going to see more of that in 2026. US equities are basically flattish for the year to date. Generally other emerging markets have done quite well. Europe has done quite well. Japan is outstanding. Korea is up 35% again. So you're seeing this kind of more balanced profile. And alongside that, I think the dollar will depreciate further. Maybe not quite the 7-8% in trade-weighted terms that you got in 2025. We are penciling something like another 3% lower in the broad dollar index. So we think that there's room to go for that further.
So it's what? Does it go towards 90?
I think over time, yes. Not necessarily...
In 26?
Not necessarily this year, yeah. Oh. But over time, I think that's the direction of travel.
A few years ago, we've seen 89, so it's
absolutely
not as if, we've seen far lower levels as well. And for Trump, President Trump point of view, it would be most helpful because
yeah, I think a world in which growth is okay, you get the Fed cutting a couple more times in a non-recessionary backdrop. That's our expectation. I think it's not, and the rest of the world doing better. That is exactly the kind of constellation in which the dollar would be expected to depreciate.
Okay, 2 more cuts from the Fed. So would you think that at least because of interest rate differential and maybe the currency not behaving, the Indian rupee not behaving like last year, do you think FI flows return to bonds?
I think you will gradually start to see that, and particularly, again, given the steepness of the curve that I mentioned, I think that the long end does start to look pretty attractive for a number of investors. Okay. So I do expect to see that, yes.
All right, let me now come to the other giant in the room, the renminbi, the Chinese renminbi. I mean, this steady appreciation is surprising. Should they not be worried about their exports? Will this stop or does this continue?
I think it will continue. I think steady CNY appreciation has been one of our highest conviction views. I think that, again, starting points are important. China's currency is something like 22% undervalued on a broad basis. That very deep undervaluation is showing up in the huge surge in Chinese exports that you've seen across the world. China's, current account surplus is already about 0.5% of global GDP, not China's GDP, global GDP. And on current trajectory is on track to get to something close to 1% of global GDP. That's a huge amount by any magnitude. And I think that part of the reason is that you have a very productive supply side, but it's also a very undervalued currency. So I think China will be able to accept a gradual strengthening of the renminbi. I think that's what's happening. We have a target of 670 by year end. That's beyond forward pricing and above consensus forecasts. And I think that even with that kind of appreciation, the currency will remain pretty cheap. And I think it will continue to support the exports. And it's another reason why I don't think India should be too concerned about the rupee weakness that you've seen. I think that cross rate matters. And relative to where CNY is, which is a big competitor, I think India is not that cheap.
Oh, actually, India is doing well versus China in terms of currency. For the longest time, I remember we paid 10 or 11 rupees for the renminbi. Today, it is 13.7.
Right.
So clearly, I mean, it is working to our advantage. Unfortunately, out of time, but not out of questions. Kamaksha, pleasure having you with us.
Thank you so much.
Well, that's a 360-degree perspective of how the major currencies for us, dollar index, renminbi, and the rupee will move. I hope you enjoyed the conversation as much as I did. That's it on this edition of It's the Economy. After a break, Chartbusters.